Good evening, everyone. Hopefully you can hear me. Thanks for joining this evening. My name's Tom Harvey and I'm with J. Edward Sellers. And thought we could have a little chat this evening about inheritance tax and hopefully some strategies you can take with you to reduce the liability of your estate. Just before we get going, a little bit of housekeeping. So I think the session this evening will last about 30 minutes and we'll have some time for questions at the end. The session is being recorded and the recording will be sent to you via email later this week, just so you can refer back to it if need be. If you have any questions, please type them in the Q&A box, which you should see at the bottom. I'll get through as many questions after the presentation as I can, and any that go unanswered, we'll get back to you later on this week. Quite an important note, none of the information today is to be regarded as financial advice or a personal recommendation. If you'd like to receive advice on your own circumstances, please feel free to give us a call. The number is in bold at the bottom there. So the agenda, let's have a look at what we'll be covering. So going to spend some time looking at the current inheritance tax landscape. We'll move on to the implications of the budget last year in October. And then the meat of it really is the strategies that you can use to avoid unnecessary inheritance tax. We'll also cover some practical estate planning tips and pitfalls to avoid, and then the Q&A session at the end. So, current inheritance tax landscape. Just to begin with a bit about your thresholds and allowances for IHTs. So the main one is your nil rate band. So that's 325,000. You'll also qualify for a residence nil rate band, which is an extra 175,000 when your home is left to a direct descendant. So for married couples and civil partners, these allowances can be combined to protect nearly £1 million worth of estate value. Anything above that is then taxed at a rate of 40%. A couple of other allowances and thresholds. So no inheritance tax is payable on agricultural property and qualifying businesses with a value of up to £1 million. After that, there's a 50% tax relief. So that basically means after £1 million, IHT is paid at a rate of 20%. Unquoted shares, including companies listed on the alternative investment market, or otherwise known as AIM, also receive a relief of 50%, giving an effective rate of tax of 20%. So, revenue generation for HMRC and future projections. So, how much is this bringing into the country's purse? So, in recent years, HMRC's tax collections from IHT have been robust, contributing a notable share to public purse. So, for context, estimates suggest that in 21-22, the total IHT liability for the country stood at around 5.5 billion. Forecasts indicate that by 26-27 tax year, the total IHT liability is to rise to nearly 9 billion, so a significant increase. So what's contributed to that? So the freeze in the thresholds until 2030 means that more estates will fall into the purview of IHT. And assets continue to grow, which is part of the point of freezing those thresholds. And again, that's going to expand the number of estates liable to IHT. So another example here, so Greater London alone is to see its IHT revenue jump significantly, with projections suggesting a 54% increase, reaching nearly 2.6 billion annually. So that's obviously a good proportion of the overall take there. So with more estates meeting IHT thresholds, families are facing a steeper tax burden, underscoring the need for financial planning in general, really. HMRC also continues to strengthen its compliance enforcements, which also implements or influences estate planning strategies. And in our view, especially, clients must regularly revisit and update their overall financial plan as assets do continue to grow, which can cause an IHT liability in the future. One thing to always be mindful of is, whilst you may not have an issue with IHT now, portfolios, properties, assets in general continue to grow, so you may have one in the future. And there's certain ways that we can pick up on that and obviously discuss it with you. So the budget in October last year was quite a big one. So a couple of changes which affected IHT. So as I mentioned earlier, the allowances or the nil rate bands you have for IHT were frozen until 2028. That was pushed out further until 2030. So yeah, fiscal drag is the term used there, but more and more people are getting caught up in that IHT net. There's also revised reliefs for agricultural and business property. So it used to be the case that 100% of agricultural assets and qualifying business property was free of inheritance tax. So now that's limited to 1 million. Obviously, Jeremy Clarkson has been jumping up and down about that quite a lot, as I'm sure some other large landowners are, and for good reason. One of the items that Rachel Reeves spent the least amount of time on was that pensions will now be included in your estate from April 2027. Something a lot of people have been doing is preserving pensions and spending down other assets because that would avoid inheritance tax. From April 2027, that's no longer the case. So plans will need to be adapted because of that. So what are the implications? So of course, it's going to be increased future IHT liabilities, impacts on family businesses and agricultural holdings, especially for both of those types of people, types of families. On death, when they're dealing with a bereavement, they're going to have to find some money to pay off that IHT bill. And because the tax take is increasing, HMRC are going to be putting a bit more scrutiny on the whole situation because there's more money there for them to get their hands on. So 10 strategies to reduce or avoid unnecessary inheritance tax. So what can we do to mitigate it? One thing I will say is that the advice here is not tax evasion. Tax evasion is illegal. Tax avoidance is legal because you're operating with the constraints that HMRC give you. So everything here that I'll be going through is above board and yeah, it's nothing controversial. So the first one is making sure you're getting as much use as possible out of the nil rate bands available to you. So as I mentioned a moment ago, we each have our 325,000. The residence nil rate band, when it's left, the property's left to direct descendants, the additional 175,000. And it's important that married couples, the surviving spouse, claims any unused allowances. That does have to be claimed through a form to HMRC, which is the IHT 400 or IHT 402 form. For unmarried couples, getting married could be worthwhile because it doubles your allowances, and IHT is payable on the second death rather than at the first. Another good strategy is lifetime gifting. So throughout your life, giving away assets so you can see the family enjoy them now and not pay inheritance tax on it later. So gifts made more than 7 years before death become exempt of IHT. So you may well have heard of the 7-year rule. Technical term for it is a potentially exempt transfer. And after the 7 years elapse, that gift falls out of your estate. And it could be worth considering gifting significant assets sooner rather than later. So if you've got a large property, a piece of land, for example, anything which holds a significant value, that's going to be creating more and more of a liability for you as the asset grows in value. And well-planned lifetime gifts reduce the eventual tax take, which is what we're looking to see. More money going to the family, less revenue going to HMRC. One thing that we need to be careful of is not gifting away too much, because your lifestyle, you're going to want to keep that up. And through cash flow modeling and other tools that we can use, we can help you get to a certain number which you can give away and hopefully still sustain your current lifestyle. Other ways of gifting, you can use small gift allowances, your annual exemption. So each year you can gift up to £3,000 per tax year. That's known as your annual exempt amount. And you can also gift small amounts up to £250 per recipient each year. Also available, if there's a wedding coming up within the family, you can gift on marriage or civil partnership. So for your own children, that's an amount of up to 5,000. For grandchildren, 2,500, and anyone else, there's £1,000 that you can give away. Another method of reducing the size of your estate, you can give to charity. So gifts to registered charities are 100% exempt from IHT, and leaving more than 10% to a charity can reduce the IHT rate from 40% to 36%. That may sound like that's just reducing the size of your estate, so your beneficiaries will get less. But in something we'll come on to a bit later, you'll see it can result in them getting more, and you're obviously taking an approach which gives to a charity and a cause which may be important to you, and also eases IHT liabilities. So you've probably heard of trusts before. Sometimes they can be a bit of a mysterious area, but hopefully I'll be able to shed some light on how that works. So there are two key types of trusts. So think of this as the top level of trusts. First is discretionary. So they can remove assets from your estate whilst retaining some control over the distribution. So you get to choose who it goes to. Importantly, with a discretionary trust, you can choose from a group of people or a class of beneficiaries. So what that may look like in the real world, you may say, I want it to go to my children and their children thereafter. So if the family grows, more grandchildren come along, they can be included in that trust without having to rewrite things. A little less flexible is an absolute or a bare trust. So again, it can remove assets from the estate, but they're a bit more prescriptive. So it's named, or a beneficiary is named within the trust deed, so that can't be changed afterwards. Trust can be particularly useful for protecting family assets and managing complex family dynamics. But something to mention is the effective use of trusts requires careful planning and ongoing review. In terms of complexity, trusts are probably towards the top end of complexity, really. So that's kind of the top level of trusts. Underneath that, there are a couple of tools that we have in the box as financial planners, financial advisors. So coming on to one of those, which is a loan trust, and I've put together a bit of an example here, which hopefully you can follow. If not, please feel free to stick a question in the Q&A, and I'll hopefully be able to answer it for you. So laid this out in a bit of a flow chart. So we've got our fictitious client, Mr. Smith. He's aged 50, and he lends 150,000 and appoints trustees to a loan trust. It's the absolute version, so there are named beneficiaries in there. The trustees invest the loan into either an onshore or offshore life assurance bond. You may go to any number of life companies, Aviva, Quilter, most of them offer life assurance bonds. Any growth within the bond is immediately outside of Mr. Smith's estate for IHT purposes. So that means that asset goes into trust, it's frozen. That growth, which I've mentioned a couple of times, making IHT worse, is now no longer an issue. That asset's frozen. So with a loan trust, there's a loan to be repaid. So 10 years after the loan trust was created, Mr. Smith asked the trustees for repayment of the loan at £7,500 a year. So there's a facility within the investment bond to pay that withdrawal. 18 years after that, or after the loan trust was created, Mr. Smith dies, and the outstanding loan is 90,000, which then falls into his estate. So hopefully that wasn't too difficult to follow. What we basically do, set up an insurance bond. A loan trust is then placed over the top with the intention to reduce the amount of money which goes back into the estate. So the numbers of let's have a think about the outcome of that. So what is the effect of us setting up this investment bond? So in this example, if the money was held outside the loan trust, the amount going back into the estate would be about 285,000, assuming a 5% per annum investment return. So that would result in £78,000 more inheritance tax payable than if the loan trust was set up. So just by one might sound a bit complex to begin with, but a simple operation for ourselves to set up for clients, that can result in a saving of £78,000. So quite significant, really. So that's one of the examples. Another option that we have is something called a discounted gift trust. So again, this is usually set up through a life company, Aviva, Quilter, whoever. So Mr. Smith, in this example, he sets up a bond with 250,000 this time. The bond is then transferred into a discounted gift trust. So with a discounted gift trust, Mr. Smith has a right to a regular income from the bond. And at outset, there's a capital value applied to that right to income. That capital value is based on various factors such as age, health, that kind of thing. So underwriting takes place through the life company. The bond provider estimates in this instance that the capital value of his income is £100,000. So that's known as the discount. So the discounted gift is the amount that is invested in the bond minus that discount that we've said. So Mr. Smith puts in 250,000. The value of his income is 100,000. So the amount assumed gifted into trust is 150,000. So straight away, that amount of 250,000, that gift is then written down to 100,000. That's an instant saving of £40,000 worth of inheritance tax. So yeah, just coming further down that flowchart now, based on the value of his right to withdraw over his lifetime, 100,000 is immediately out of the estate. The remaining fund value is out of the estate then after 7 years. So we've got that immediate write down, 7 years, it's all out of the estate. So quite an effective way of mitigating inheritance tax quite quickly. Comparing the two against each other. So with a loan trust, the settlor, or Mr. Smith, has access to both income and capital. So he could demand a bit more of the loan is repaid, say take out £10,000, and still then have the remainder of the loan repaid. With the discounted gift trust, things happen a lot quicker. It's out of the estate a lot quicker, but there's no right to capital. So if Mr. Smith changes his mind and he says, well, I want a lump sum, that lump sum isn't available with the discounted gift trust. That's for the beneficiaries. He only has the right to income. Another quite important point with both of these types of trusts, if that income is taken and then hasn't been spent, it then builds up within the estate again. So it's very important that that income is spent once it's paid. Otherwise, we're just creating another problem somewhere. So again, if that was a bit too difficult to follow, pop the questions in the Q&A and I'll come back to you on those answers. Okay, back to our 10 strategies then. So structure qualifying assets strategically. So business property relief. So this is your family business, can offer 100% relief on qualifying business interests. So I've mentioned qualifying business interests there a few times. What a qualifying business is really a trading business. If you've got a limited company set up and you're investing in residential property, for example's sake, that isn't a qualifying business. that will get looked through straight away, and you'll pay inheritance tax on the full value. So making sure if agricultural property relief is there, making sure you're getting full use out of it. So as again I've said earlier, the full rate of relief is available up to £1 million. Assets after that, making sure you structure them effectively. So if you could give part away, so somebody else, say a child, benefits from some of that relief as well. Also investments in unquoted shares. So there are AIM portfolios around which give 50% relief after a 2-year holding period. So say if you put £100,000 into a portfolio of AIM shares, after 2 years, that reduces the rate of tax on that portfolio from 40% to 20%. There is a bit of a risk warning though that's needed with AIM portfolios. So the alternative investment market is home to the smallest companies in the UK. They're very illiquid, many go out of business, so it's on the spicier end of the risk spectrum. Another strategy, which is quite common actually, is insuring against the IHT liability. So what you can do is set up a whole of life insurance policy, which pays out an amount to cover the inheritance tax liability. So an example of that, if as a couple you had £1,100,000 worth of assets, so your inheritance tax liability was £40,000. You can set up an insurance policy which, on the death of the second spouse, pays out a lump sum of £40,000, which settles the inheritance tax liability. If that's a route that you go down, it's very important that that policy is written in trust, because if it's not, that lump sum payment will come back into the estate and inheritance tax will be liable on that as well. So quite an important thing to check, especially if you've got, a whole of life policy set up already. Definitely the thing to check is that that's written in trust. A very useful one, one that is a bit of a slow burn, but a very good thing to do, is regular gifting out of income. So in addition to the allowances that I've already mentioned, you can give away as much as you like out of income, as long as it doesn't diminish your standard of living. So income could be anything: unused pension income, interest from savings, or dividends from a share portfolio. That can all be gifted tax-free. So it's out of the estate. And if you think you give away £1,000, that's a £400 saving from inheritance tax. The key to this is that it must be regular, and the recipient cannot benefit from any of the other allowances that I've mentioned previously. Very important as well that a record of these are kept, because if it's not, it could be included in your estate anyway. And yeah, by the by, very, very useful, a useful one to take into account. So you could also reassess property ownership arrangements. So reviewing the structure of property and how it's owned, considering options like tenants in common over joint tenancy, gifting property early, being mindful of the gift with reservation rules, can also reduce the taxable value. A property transfer strategy may require balancing with current living arrangements, obviously with long-term tax planning goals in mind. Another one is spending the kids' inheritance. So you've got that liability there, it's building up, it's either going to go to the kids or to HMRC, making sure that you enjoy some of your assets as well when you've got the human capital or the lifetime to be able to do so. At the end of the day, if you've got an inheritance tax liability, you've probably worked hard to get there. It's important to spend some of that on yourself as well, and do the things that you want to do. At the end of the day, life's not a dress rehearsal. So yeah, if you've got a bucket list, try and start ticking some of those things off. An acronym that's widely used for this is skiing. So spend the kids' inheritance. Okay, so I think we've got about 5 minutes or so left of the presentation. So going to move on to practical estate planning tips and some pitfalls to avoid after a very quick drink of water. Okay, so one of the big changes I mentioned earlier was the change of pensions now being brought into the estate. And this can be a particularly nasty one, if I'm honest. So from April 2027, any unused pensions will be included in your estate, and it can lead to a double taxation if death occurs after 75. So in this example, if IHT applies, £100 of pension savings would incur a 40% tax charge. This is kind of under consultation with the pension providers at the moment, but the likelihood is that the revenue will just come in and scoop that 40% out. So that reduces that £100 down to £60. If the pension holder passes away after the age of 75, the remaining sum that's left to beneficiaries is subject to the beneficiary's income tax rate. So in the worst case scenario, if the beneficiary was paying the highest income tax rate of 45%, the beneficiary would only receive £33 for each £100 of pension savings. So that creates an effective tax rate of 67%. As I said, a particularly nasty one, and there are ways that can be avoided. So some pensions will only allow a return of fund at death, so they force the beneficiaries to take a lump sum, and that's where this gets particularly nasty. And if you think, if somebody's been using a pension to save for against inheritance tax for a number of years, a pension at 75 could be quite large. And if all of that gets paid out in one go, say a £200,000 pension, you're going to be very quickly up into that 45% rate of tax when considering other income that the beneficiary receives. So any guidance that either you, family members may need around that, feel free to reach out to me, and I'll quite happily talk to that about that in a bit more detail. Okay, another pitfall, so not keeping detailed records. As I mentioned a moment ago, especially with regular gifting, it can be quite easy just to do it regularly, not really make a note of what you're doing. But do a favour for the people, your executors, people dealing with your estate, and keep detailed records of what you're giving away, basically. Especially important for that regular gifting is making sure that it's documented that is your intention. So say if it's your intention to regularly gift, you do so for 6 months and you pass away. If you've got it written down somewhere that is your intention, that will be excluded for IHT. So very important that that's done. Another pitfall is gifting or spending too much. So whilst gifting and spending is a good way to reduce the liability, it does need to be balanced with your future needs and priorities. As I said earlier, we use cash flow modelling tools at J. Edward Sellers, and what we tend to do with that is forecast out for quite a long time, make sure you've got enough money to see you through that period, and any of the surplus can then be gifted. But you need to keep on top of that. And coming back to that life policy, if it's held outside of a trust, that's going to come back into the estate and potentially cause a greater liability. So if we're giving away a property, we also need to take capital gains tax into consideration. So gifting a property to, say, a child of yours is regarded as a disposal for CGT purposes. So if you were giving away, say, a second home, a buy-to-let that you may have, CGT is payable, and they're after it quite quickly. So that needs to be balanced with, are you going to be better off from an IHT point of view? Or are you going to be better off from a now point of view with regards to your own cash flow? Another one, when giving away property, especially say you can be caught with this even if you sell a property, move in with your children, is gift with reservations. So what this is if you were to, say, give away a property to your children, they own it, but you still live in it, you need to pay a market rent. Otherwise, it will still be regarded as your asset when calculating IHT, which is, yeah, particularly nasty, really. So a couple of other pitfalls: potentially exempt transfers or the 7-year rule. So there is a bit of a misconception here. So the inheritance tax, which may become payable on a potentially exempt transfer, tapers down towards the end of the 7-year period. You may have heard of this before. There is a common misconception that the value of the gift is tapered, which is not the case. It's the tax payable on the gift which is actually tapered, which can, with that in mind, it can change your decisions and the route that you go down when planning for IHT. There's also something else which isn't heard of as much called the 14-year rule. So although gifts become fully exempt from IHT if made more than 7 years before death, the 14-year rule refers to the extended period over which lifetime gifts can affect the calculation on available tax exemptions. So it's actually a cumulative calculation, and gifts made within a 14-year window can actually affect the allowances that you have available to you. So it's not as simple as it seems on the face of it. Yeah, I think I've probably said enough on that one. Another one for estates over 2 million. So for the larger estates, as you breach 2 million, you start to lose the residence nil rate band. So for every £2 over 2 million, £1 comes off of the residence nil rate band. That allowance if you leave property to direct descendants. A gift to charity can start to claim back the residence nil rate band, though, which is what I mentioned earlier. Giving to charity can actually result in a better lump sum for your beneficiaries, because they start to claim back the residence nil rate band and the tax rate reduces to 36%. So another little tip here: so in some circumstances, a family may have an inheritance tax liability because of property or other assets which may not be that liquid, so built up in land or property, for example. In those instances, there can sometimes be a case for going down the equity release route, because it generates a bit of liquidity. The lump sum that's generated can then be deployed in, say, a loan trust, which we've covered, or a discounted gift trust. So a bit more of a cohesive plan to reduce the liability and get some access to money early on, really. Not something that J Edward Sellers directly advise on, but yeah, definitely something to keep in mind. Last couple of tips then. So for an unmarried couple, maybe consider tying the knot. Obviously, with tying the knot, you then get extra allowances, and IHT doesn't occur on the first death. Sometimes there's also the ability to get allowances for IHT above 1 million. So if you lose your husband, wife, or civil partner, you inherit their allowances. If you then remarry, you also get an additional 500,000 potentially from your new spouse. If they're bereaved, they also get that extra 500,000. So there's potential for allowances upwards and above of 2 million. If you're getting more than that, you've probably had quite a sad story in life. But yeah, it's worth bearing these things in mind. Okay, so failing to claw back overpaid IHT. So if on death there is a probate value drawn up, which is the value of a property as of the date of death, if your executors sell that property for less within a 4-year window, they can claw back any overpaid IHT. That's also an option for quoted shares, so shares that you may have in a portfolio with yourselves or any other investments, sold at a lower value within 12 months from death, which is again quite useful to know. Last tip, and this kind of coincides with kind of coincides with regular gifting. So if you're gifting out of income, what you could do is ask that the recipient adds that to their pension. Most pension providers will also allow you to contribute to a pension on behalf of another, which can lead to a positive outcome if you pay basic rate tax and the recipient pays higher or additional rate tax. So if we think about this as an example, so you receive £100 pension income, you don't need it, so you can gift it. You've paid 20% tax on that. If that then goes to a basic rate taxpayer and goes into their pension, they get 20% tax relief on it. So it's actually a kind of a positive situation from an IHT point of view. More money is being kept within the family. If that person is a 40% taxpayer, you're paying tax at 20%, they're getting tax relief at 40%. So it's actually a tax positive situation again. So quite a useful one to know. But again, just coming back to that rule that money that goes to family through the your annual exempt amount, your 3,000, they can't then benefit from the regular gifting out of income. An example though, what you may do, say if you have 3 children, you give the 3 children £1,000 each, that's your annual exempt amount covered. And then the grandchildren, you could set up a pension for them and your regular gifting out of income could go through that. Which, yeah, kind of setting up the grandchildren for retirement themselves. Also, one to be mindful of is whether you've made any large gifts into a discretionary trust. So you can actually end up paying lifetime inheritance tax. So if you put more than your nil rate band, so the 325,000, if you put more than that into a discretionary trust, you can end up paying lifetime inheritance tax at a rate of 20%. So for example, if you put 425,000 into a discretionary trust, the tax payable on that would be 20,000. If it's paid by you, it will actually be more because you're diminishing the estate. So HMRC gross it up at the end of the day. So again, labouring that point, trusts are a more complicated area. So advice is really needed with them if you're not competent. So that's the bulk of the presentation done. I've gone a bit over the half an hour, but yeah, I'm just going to see if I can find the question and answer section, see if there's any questions there. You will just have to bear with me for a moment because it is a new webinar platform that we're using. Okay. Okay, it looks to me as if we have no questions and answers. If you wouldn't mind just bearing with me a moment more, I will just make sure I'm not making that up. Okay, so looks like we have no questions and answers, but yeah, if I've got that completely wrong, as I say, new webinar platform for us, so I'm not sure I'm looking in the right area. Any questions that have been left there, I will get back to you by email by the end of this week. But thanks again for your time. If there's any further questions, or if you'd like to speak with me personally about what we've covered today, my details are up on the screen now. But yeah, if not, thanks for joining, and yeah, hope to see you at another webinar in the future. All right, thanks all. Bye.